Hi, and welcome everyone. Thank you for tuning in to today's webinar on the oldies but goodies of the year in tax planning. It's the first in our series for this fall. My name is Nancy, and I'll be your moderator for today. Before we dive into our short presentation, just a few housekeeping notes to mention. First, everyone is muted to limit disruptions. If you have any questions, you're welcome to share them with us using that questions feature in your GoToWebinar's control panel. And if we have time at the end, we'll go through those questions, and if not, we will follow up with you after the webinar. The webinar is being recorded, and you'll receive a copy of it in your email tomorrow, along with a copy of the slide deck. And upon leaving, you'll be prompted to complete a very short survey. Please take a moment to share your feedback with us on your way out. We'd love to know your thoughts. And with us today, we have our resident tax and accounting experts, Suzanne Cox and Michael Cole, leading our presentation. And since we have a very short time, I'm just going to turn it right over to Suzanne to get us started. Suzanne?
Thanks, Nancy. I know, Nancy, you've already taken up like 42 seconds of our presentation. So just to highlight that point, it is a quick presentation, and it was meant to be. So there will be some slides with a lot of information on it. We are not going to cover those in depth today. We are doing very high level things to get you thinking about year end. It's that time that you need to get with your CPA, whether it's us or someone else. So these are generating idea topics. So when you look at the slide and say, oh my God, this is not what I signed up for, we are doing very high level. And of course, you can reach out if you have further questions and set up meetings and schedule appointments to get into those a little bit deeper. But we know you're getting the slide deck. So we did put a lot of that information in the slides just so you've got it there, but we're not necessarily going to get into it today. So let's get started. What can we do, Mike?
So when you think about year-end planning or any tax planning at all, there's always kind of four pillars that you need to balance in order to make anything work, and that's time, assets, liquidity, and flexibility. And so as we look at year-end planning, time is always kind of crunched down, and it's really, really short because we need to get things done kind of before the end of the year. So the key factors that you can really look at that are the methods and periods, which are the way that we analyze journal entries for tax and GAAP. You can plan to take approach for fixed assets and some methods that you've been doing throughout the course of the year, but you don't have to make any elections about them until the end of the year. You can look at credits and incentives, which are things that oftentimes we're doing anyway, such as research and development. Even if we don't think of that as necessarily being tax driven, there are certain tax attributes that we can draw from that to really kind of minimize our tax burdens. And then there's always a question, especially these days, about retaining and drawing in new talent, because as we've all heard about the Great Recession that happened in August, there's this new move and this new push to keep some of that key talent because it's always harder and more expensive to replace somebody oftentimes than it is to keep them. And finally, it's, if I'm a business owner, what should I be thinking about as this year comes to end about my personal finances and my investments within my organization? So as I mentioned, it's really kind of that time frame is now kind of crunched down. So now we're just playing it kind of at the fringes in order to really minimize or plan for our tax burden for the year.
So we have a case study that we're going to walk through here. And I got a little tongue-tied earlier, but it is Cliffy Biro. And Mike and I both have said that a few times practicing, so hopefully we'll get that right today. So a little bit about them. They are owned by 3 equal owners. And of course, on the call, there'll be some of you that have partners and some of you that own the business 100% yourself. And so this could go, we're going to give you little examples in both scenarios. But this company specifically has 3 equal owners, and they are a manufacturer. They make electronic equipment. They do have a long-standing key employee, like Mike just mentioned. They do have somebody that they want to retain long-term and want to make happy and is hoping they're not looking, right now. They are looking at getting into new states. So that has been really popular in our client base, exploring options in new markets and also employees moving to new states or relocating. And so what does that mean for your company? And lastly, they are using the accrual method of accounting.
So, as we kind of talked about a little bit earlier, when we're thinking about year-end planning, the first question that always comes into mind is, am I a cash-basis taxpayer or am I an accrual-basis taxpayer? The reason why this is oftentimes so key is that cash-basis taxpayers lose the benefits of accounts payable, being able to take those deductions on the front end, but then they gain the ability to defer income relating to their accounts receivable. And so there's always a decision that needs to be made by a lot of companies, once every 4 or 5 years, about whether or not they want to stay on the cash method or they want to move to the accrual method. As we kind of look and we talk to a lot of our clients, one of the key drivers that oftentimes moves these is whether or not they're actually looking to do trust and estate planning, reorganizations, or if they're kind of in a cash strapped or cash push position. Because using the accrual method, oftentimes, while you can accelerate some income, you also might be accelerating more payables than income. And so it really kind of becomes a balancing act and a review thing that you need to look at on an annual basis to figure out what's the best way and what's the best method for us to minimize our tax burdens. Another area that oftentimes is a consideration for companies, and especially this year, relates to meals and entertainment. The old rule used to be 50% of meals, 50% of your entertainment, unless you were providing meals for your employees on staff. So say, for example, you were a hospital and you were providing the doctors and nurses meals on the premises so you didn't have to go and hire short staff, or you're a manufacturer and you're working in shifts and your shifts have block shifts for your meals, so you're providing them on staff so people don't have to leave and they can just stay on the premises so your machinery keeps working and there's no slowdowns in your production process, right? So what's different about this year is that now if you have been buying meals or you've been insourcing meals from restaurants, those are now 100% deductible. And what's really interesting is where you saw a lot of companies taking action is that they chose to use Grubhub gift cards and other things. So if they had employees that were working from home or other locations, they were actually able to provide some, quasi fringe benefits and kind of have moments of togetherness with their employees by having everybody share a meal, just doing it virtually, right? And so these are things at the end of the year, as you're kind of sitting down, you're thinking, oh, maybe we can't have our Christmas party this year because of, whatever restrictions we're either placing on ourselves or our workforce is kind of moved and is no longer coming into one central hub. These are areas that you can be thinking about to kind of manage your cash flow and manage your tax burden while still kind of providing some good benefits and good inclusion within your organization. Another area of common questions that arise relates to what's called Section 263 Cap A. And this relates to how much of our overhead really kind of gets included in our inventory. And so the classic example of this is that, you're making widgets and you spend $5,000 on metal, but then you've got $150,000 of management, storage fees, and other things. How much of that gets included in your inventory calc for figuring out whether or not what your cost of goods sold are for the course of the year? Of course, you want to drive as much of that out of your inventory as you can, because then all of a sudden it becomes instantaneously deductible. And so one of the really interesting things about COVID and a lot of the shortages that we've had with a lot of our inventory is that people either have a lot of excess inventory because now they're pre-ordering a lot because they don't want to wait for things to be delivered later, or they're running so short that they're really short on pieces. And so, there's not much of a separation between being able to expense it or them running out of their inventory at the end of the year. And one area that's really nice that you can have a conversation about and some good planning can be done about is how is it that you can either pre-order more inventory pieces now to be able to take deductions in the current year, and how much of that work that you're doing now no longer relates to inventory, but now is management of your asset flow. So you're able to kind of pull some of that more of that management expense out of that inventory inclusion and your cost of goods sold and more into the general operations of the company. And so 263A is an area where we're seeing a lot of conversations with our clients. The next area relates to state and local taxes. If you haven't heard of SALT, it's a state and local taxes. It's a common abbreviation. And, Suzanne, we were actually just discussing this about how remote workers are now changing state and local nexus and whether or not, we could have employees there. You maybe want to go through one of our clients that we were actually just talking to?
Yeah, so we've got a lot of clients right now. I think I get this question daily. We had a person move to Utah. We had a person move to Massachusetts. And so we've been diving into the particulars as it relates to each state and have found that they are vastly different. So if your employee decides to move to a state that requires Nexus, then that might be unfavorable to you, and you may now have to file in that state and file a tax return. So there are some ramifications of your employees wanting to move different places, and so we can, of course, help you with determining what those effects might be.
Yeah, that's absolutely right, and a really great point, especially now as not even moving, but just the search for talent too, right? How oftentimes are we like, oh, we found somebody who can code, or we found somebody who has this skill set, and they're located in a different state from where we operate in, and they're going to be working remotely. A lot of times, you're not thinking about, well, oh man, I've got $100,000 in sales. Yeah, right. Or I now need to register with the state relating to employment taxes, right? And so there's a lot of confusion and complexity around that area, but there's also some planning opportunities. Because when you think about, oh, I've now moved somebody into, let's say, Iowa from Illinois, well, man, if I can now start sourcing more of my income to Iowa versus the Illinois rates, which are much more complex and much more expensive, all of a sudden now there's some real tax savings for me as a taxpayer. And also there's a greater simplification process for some of my buyers, right? And so just because it's adding complexity doesn't mean it's adding a negative. Sometimes being able to shift income from one state to another really can drive great value. And that leads to the conversation about transfer pricing. A lot of companies, oftentimes, when they hear transfer pricing, they automatically think international taxation, right? I've got a company in Beijing, I've got a company in Florida, and I'm buying the widgets being made in Beijing, and I'm, breaking bulk in Hong Kong and then importing them to Florida. But what a lot of folks tend to forget is that you can also have interstate transfer pricing. And so if you've got IP that's being made and manufactured in, say, California, because that's where you've got a Silicon Valley kind of startup going on, and all your coders are located, but you've got operations in Florida that's actually using that IP, how much of your revenue and how much of your income can you shift between the two locations that you're operating in, and really kind of assign value and not just assume that everything that comes out of California is really going to be California based, because there might be some type of a license fee using subsidiaries or other attributes that can be used to shift income from one state to another. And so don't
right
think
now,
about transfer pricing.
Yeah, just breaking in right now, this is really hot. The economy has been picked up and shook and dumped out. And so a lot of our clients, not just in manufacturing, but in other areas as well, and other industries, are starting to do work in different states and starting to look at different markets. And I think economically, the US is starting to, hey, can I make this product here versus getting it from somewhere else? And so there's plants popping up all over the place. And I think this is really, to your point, Mike, a really hot issue that's not new, but sort of new.
Yeah, absolutely, especially as our workforce really spreads out throughout the country. And so just kind of continuing down this list, here are the last three: business interest expense, can I prepay my, the mortgage on the building or whatever it might be in order to get that deduction in the current year rather than waiting until next year, right? Can I adjust my fiscal year and cause a break off because I'm finding now that in this new economy, all of my sales are coming in Q2 rather than in Q4, right? Because everybody's pre-buying all their inventory now. So now I've got to shift. And can I now change the way that my year end works to shift the way my income is going to be recognized so I can pick up maybe a 6-month permanent deferral? And then last is, of course, whether you're on accrual method or you're on the cash method, if you've got a line of credit or you've got credit cards, any purchase that you make before the end of the year, even if you don't receive that product, you're able to take that deduction. And so it's really, really common, especially among manufacturers, is to put in a giant order at the end of the year with their suppliers and then pay for it using a credit card or a line of credit to make sure that they're getting that deduction in the current year. The one thing I'll caveat that with is, remember, that means that you're now pulling that deduction from the next year, right?
Right.
So if you make $1 million purchase at the end of this year, that means you're now yanking $1 million of deductions out of 2022. So that's kind of the balancing act that needs to be considered as you look at your forecasting and modeling, which can be really, really important. I mean, Suzanne, how often are you talking to the clients about, what their budgeting process is, kind of with how in flux everything is?
All the time, of course, and some people on this call may have a budget and a cash flow forecast, and some people might not. So that's part of year-end planning. It's one of the most important pieces is, where do you think you are going to land this year and next year, not just this year, but for the next couple of years, so that we can do a trajectory of tax planning for the next few years. And so if you haven't done that exercise yet, it's definitely important. And we do have a shameless plug here, do have some webinars on some cash forecasting on our website if you would like to get some more information on that. Let me move on here. I think we killed this slide. So this is again maybe a high level, or I said we're going to talk on a high level, but this slide gets a little bit deeper into one of the most common deductions, I would say, especially in our client base, is the purchasing of assets. Especially manufacturing and construction industries, they work with heavy equipment and machinery, and so purchasing assets, and again, coming up with a budget. What are your needs for the next couple of years from an asset standpoint? When do you need to replace your assets over the next few years? Those are things that you really need to be looking at and having, a budget for, is when are you going to need to replace your capital assets? So Mike, you want to dive into those a little bit more?
Yeah, and again, just kind of keeping at a high level, the real important part is to be thinking about this as a bunch of different Legos as you think about fixed assets, is that just because you bought, let's say you have a woodworking company, right, and you bought a new router, and then you also bought 5,000 router bits to go with it. Well, you actually just bought 5,000 individual assets and one large asset, right? And so as you're thinking about what it is you're going through and how it is that your cash flow and your tax planning, we really like to sit down and think about it as, what do the owners need and what does the company need, as Suzanne was talking about, as part of that budget and long-term planning for how it is we're going to treat that. One of the key areas that is not changing from what we understand with the reconciliation bills that are going through Congress right now is that bonus depreciation is going to start phasing out in 2023. As well as the NOL rules are going to be augmented to revert to what's referred to as pre-2017 rules, which is an 80% as well. It's the lower of 80% and then changes to your post-2017 losses. And so as we start thinking about, how much of those losses are going to be carried forward, what can I carry back? The bonus depreciation is going away. How is it that I can start planning for the assets I'm buying now, when maybe I don't need $1 million of depreciation in this year? Maybe I only need half of that. Can I break these large asset purchases into little pieces? And, of those little pieces, what do I want to defer for later deductions versus what I want to take now as current deductions?
So speaking of, long-term planning and goals, this is one thing I am always asking about, is what are your goals? What do you want to achieve this year? Because sometimes they conflict if you have multiple partners, and one partner may have a different goal for this year than another partner. Individually, you may say, well, this year I really need my balance sheet to look great because I've got to get a line of credit or I've got to get a loan, and so maybe the tax planning might have to take a small back seat that year, so you can beef up your balance sheet. And then the next year, we go a little more aggressive on the tax planning. And so our company, Cliffy Biro here, we've got 3 partners. And as you can see here, Simon wants to grow, then thinks they're going to grow by leaps and bounds. Ben, he needs deductions. And James wants to diversify. So as you can see, these are different goals here for the same company. So part of tax planning is sitting down and understanding what the company's goals are, and ultimately we've got to balance this and come to a plan that meets all of the needs of the owners. In this case, they're also looking at buying a $1.5 million asset. So Mike's going to dive into a little bit of the strategy that you might think about for this type of company.
Yeah, Suzanne, that's a really great way of setting it up, because whenever you think about the companies, especially mid-sized and closely held businesses, you always want to be thinking about the heartbeats, those people that own the company, that are there every day and are trying to see the company grow. And they, a lot of times, maybe something that they've been working together for 5, 10, 20 years, maybe they're on their second generation of owners, they start to drift apart, or they start seeing different needs, or they have different wants, both from a cash flow standpoint and from a tax standpoint. Mm-hmm. And so as we kind of look at this organization, we want to be thinking not about what's best for the company. We want to be thinking about what's best for the owners. And so, with Simon thinking that company revenue is really going to be growing by leaps and bounds, that might mean that he wants to make sure that he's going to have deductions to shield his income going forward into the future, right? Ben needs deductions in the current year in order to offset income that he has from some of his other investments. You know, a lot of times, one of the things that often gets overlooked when we're talking with businesses and business professionals is that they're thinking about, they put on their business hat and they forget that they're, you know, an individual, or that there are various owners. And so, you know, Ben really needs these deductions, and he might not be sitting down as a part of the conversation about, he might not be thinking about his personal needs as he's talking about the company. And then James is saying, hey, you know what, this has been a great run, but I'm looking to diversify my portfolio. I maybe don't want to put in $1 million or whatever it might be, or I might not want to be able to use company funds to buy a large purchase like this, right? And so what we would do here is we would sit down and we would say, okay, well, what asset are we really buying for $1.5 million? If you're buying a $1.5 million asset, chances are you're really buying a $1.25 million asset, and then you're upgrading electrical lines, you're upgrading plumbing lines, you're changing the way that you can bring equipment in and out of a building, because it's going to be such a large piece of equipment, you won't be able to fit it in through your normal garage doors or whatever it might be, right? And these are all pieces that we want to look at. And so what we would do is we would sit down and we'd break out the pieces where maybe we can accelerate deductions in the current year to facilitate Ben's needs of really kind of driving down income in the current year. And then we'd say, well, Simon thinks that this company is going to really be growing into the future, and James wants to diversify his portfolio. Perhaps James would want to set up a new investing company where he's going to be leasing assets, not just to Biffy Clyro, but to, sorry, I actually said the real name of the band, Cliffy Biro. He's going to be leasing assets to Cliffy Biro and to other organizations, taking in basically an interest and a referral and a management fee for holding those assets. So now he's no longer going to be directly investing his capital into one entity. He's going to be able to start diversifying and spreading that cash flow across various investments, and he'll now have a platform to make that happen. Well, at the same time, Cliffy Biro is going to be able to take that lease payment every single year going forward, right? And so when you look at it like this, what would have been a, hey, we're just going to take a $1.5 million write-off this year because we can under bonus. All of a sudden now we're getting Ben the deductions he needs. We're getting James the ability to diversify his portfolio. And we're acknowledging Simon's thoughts about needing deductions in the year's future when maybe they wouldn't have any because they've been bonusing everything out for the last 5 or 6 years. We're creating that nice long-term shield against income without requiring a lot of capital upfront from the company to make a big asset purchase. And so all of a sudden now we're able to kind of blend all these different strategies to meet different goals.
Is anybody else getting excited? I know I am. We're a blast at parties, I swear. So moving on here, I believe we're running just a bit short on time, Mike. So this might be a slide we glaze over.
Yeah. So this is the real kind of oldie but goodies. You know, in the last few years, we've had some extended carrybacks, especially for individuals. We could go back 5 years. For organizations, the 80% rule has been eliminated, so we can kind of take deductions going back without having to worry about losing 80% or being limited to 80%. And so the real key here is, as you're thinking about your filing season this year, be thinking about, you know, can I really use those NOL carrybacks, or have I been performing some type of R&D service that's really been setting up my company, especially during COVID times? A lot of organizations had to change the way they operate, had to change the way that they're manufacturing. And even if you're not putting out new products, the fact that you researched into how it is you could now use a different work product, or you might be using a different methodology, can count towards that R&D credit. And you won't know until we've had a conversation about what's a good expenditure and what's a bad expenditure. And, you know, getting $1 of a deduction versus $1 of credit is huge, right? It's basically a 70% change in the value of $1. Yeah. So those are really, really key and important things to be thinking about.
So do you wanna move on, Mike, to the Great Recession or the Great Resignation? It's hard to get those straight. So that's been, I will tell you, this year in my strategic meetings with clients, that's the first concern that comes out of their mouth is where, you know, it's hard to find the right labor. And so I think that's an important distinguishment is, you know, labor isn't necessarily hard to find, but the right people for the right job at the right, you know, amount that you're willing to pay or benefits that you're willing to sacrifice. And so, so this is really hot right now. And how do we retain those great people that, you know, that fit your company's goals? So we've got Eleanor here. She's key. She has a rare skill set. And, you know, how do we keep Eleanor engaged? How do we keep her, you know, from looking? Oops, shouldn't have gone too far. Here we go. Mike, you want to talk about some of the options we have for Eleanor? Oh, I didn't skip. Yeah, that was good. That was the right slide.
So a lot of times when you've got a really great employee like Eleanor is, and you want to retain that talent because the cost of replacing him or her is going to be way greater than it is of retaining, there are oftentimes two paths that you go down. One is by providing them incentive units where they kind of vest in the future. So, hey, you agree to stay with me right now, and I'm going to give you a big bonus and some ownership piece into the future, right? And so that's a good way to making sure that your talent stays local and they feel affirmed in the value without the current owners having to necessarily give up any ownership right now, right? So it still allows for continued operations. It's not going to impact anything, but at the same time, you're still kind of drawing in or keep retaining that great talent like we know Eleanor to be. Other times, you're saying, well, I don't want to give up my ownership of the company because I've got trust and estate planning done. I've got, you know, generational thought process where my daughter or my son is going to come in and they're going to be taking over as CEO and they need to be able to take equity. And, you know, to make the economics work among the shareholders or the partners, we need to be able to retain equity as it is. That doesn't mean that you can't provide something like equity to key employees. And a lot of times this is done through what's referred to as phantom equity or round tripping somebody. And so what that means is that you would set up a bonus plan, you would set up a methodology to provide something like equity. So if the company made $1 million and you want to give a 10% phantom equity, you would basically create a bonus pool of $100,000 to give to your employees. And then you would round trip them, meaning that you would gross up their income. So let's say they would pay 40% taxes. You would kind of give them an extra 40,000 and then like an extra 20,000 in order to minimize the amount of the variance between what they would have gotten had they been an equity member versus just getting a W-2 bonus out, right? And so you basically give them the benefits of the ownership without actually liquidating down your investment capital. And these can be really great ways to kind of make and retain talent.
Yeah, absolutely. This, like I said, this is hot. We're getting questions consistently about, you know, these types of plans. So, and so we've got just a few minutes left here. So just high level, again, these are, you know, the slides are meant because you're going to get them. And so these are things that we'd like you to think about when you're approaching year end. And we're not going to dive into these too deep. We've got 2 more slides, Mike. So you want to talk about anything specific on this one, or you want to move to the next, which is I guess that one's what we're going to discuss next week. So let's touch on this one real quick.
Yeah, I think the real one to think about here is making sure if you're thinking about gifting some investments to children or to your spouse or whatever it might be, it's always important to look at how much gifting you've done during the current year. And the other piece is to think about distributions and sales. We were actually consulting with a company that's selling, and we told them to move from 12/31 to 1/1. And in doing so, they actually shifted their quarterly estimates, all those other pieces, to allow them to basically defer the tax obligation for an entire year by using minimum payments and shielding them in other ways. So there's really some great planning that can be done between using 12/31 and 1/1.
Absolutely. So we got about a minute left. So next week, we will be discussing a few things that are, again, pretty hot right now: employee retention credits, PPP loans, forgiveness related to that. You guys know me from the PPP days. We're going to revisit that as well as some of these other things: state filings, gains on acceleration or gain acceleration on investments, and so forth. So Nancy, I see you popping back in here. We've got to our last slide, and Nancy has a few wrap-up items for us.
Yes, thank you, Suzanne and Michael. Very informative session on these oldies but goodies of tax planning. But like we mentioned, you'll all receive a copy of the slide deck, And if you have any questions, reach out to us, reach out to Suzanne, Michael, or another member of our tax team. And we'd love to answer any questions that you have. But be on the lookout tomorrow for the recording along with that slide deck. And be sure to check your spam or junk folders in case it gets caught in your security filters there. And we hope you guys can join us next week for our next webinar in this series, and also the week following for one on individual tax planning. But with that, I think I'm gonna let you guys cut loose, and we hope you guys have a great rest of your day.
Thanks, guys.
Thanks, everyone.